Welcome. If you run a family trust, one decision can quietly shape its tax position for years to come: the family trust election. It's often misunderstood as an automatic tick-box benefit, when in reality, it's a permanent, deliberate trade-off. In this video, I'll explain, in plain English, what a family trust election actually is, when your trust should consider one, and the very real risks to weigh before you make it. I'm from the advisory team at Quantum House Australia, accountants and tax advisors. Please treat everything that follows as general information, not personal tax advice. Your own circumstances always matter. So what is a family trust election? In technical terms, it's an irrevocable election made under Schedule 2F of the Income Tax Assessment Act, 1936. In plain terms, it's a trade-off. You nominate one person, the test individual, and the trust's distributions are then restricted to that person's defined family group. In exchange, the trust unlocks tax concessions it otherwise couldn't reach. It's particularly relevant for discretionary trusts and unit trusts. Here's what we'll cover: when to consider an election, who's in the family group, and the distribution tax that guards it, the three-tier franking credit test, trust losses, and what an election bypasses, and finally, a worked example with the key risks. An election is never mandatory, but there are 5 situations where a trust should seriously consider one. First, to access franking credits, where the trust would otherwise fail the pattern of distributions test and lose the credits attached to its dividend income. Second, to use prior year tax losses it can't otherwise claim. Third, to support bad debt deductions under Division 165 or 175, which depend on continuity tests. Fourth, to preserve and pass on trust losses under Division 267, where the control test would otherwise fail. And fifth, to bring related entities and beneficiaries inside the family group, and so avoid punitive taxation on in-group distributions. If none of these apply to your trust, an election may simply not be worth the restriction. Here's the catch that makes this a genuine trade-off. Once you elect, distributions are restricted to the test individual's family group. Step outside it, and family trust distribution tax applies at 47%. So who's in the family group? The test individual, their spouse and former spouses, their parents and grandparents, their children and grandchildren, their siblings, nephews and nieces, and lineal descendants, along with the spouses of those people, and certain companies and trusts where the right election is in place. Distribute to anyone outside that group, and the 47% tax bites. It's a deliberate penalty, designed to keep the concessions within the family. A trust with no election never faces this tax, but it can't access the concessions either. The distribution tax is simply the price of admission. Now to the most common misunderstanding of all: franking credits. To pass franking credits through to beneficiaries, a trust must satisfy 3 separate rules, and an election only bypasses one of them. Rule 1 is the holding period rule. Shares must be held at risk for at least 45 days, or 90 for preference shares. An election does not bypass this. Rule 2 is the related payment rule, which denies credits where the dividend benefit is effectively passed to someone else. An election does not bypass this either. You simply avoid those arrangements. Rule 3 is the pattern of distributions test, which requires distributions to stay substantially the same over 4 years. Most discretionary trusts fail this, because flexibility is the whole point of the structure. And this is the only one, that a valid election deems satisfied. Trust losses are the other major reason to elect. For a discretionary trust carrying forward losses, an election is often the only way to preserve them. The Division 267 trust loss tests include a control test. The same people must control at least half the trust's income or capital in both the loss year and the claim year, and an income injection test. Discretionary trusts usually fail the control test because beneficiaries have no fixed entitlements and control shifts from year to year. So an election is often essential. Here's the summary worth remembering. For franking credits, an election bypasses only the pattern of distributions test, never the holding period or related payment rules. For trust losses, it can satisfy the control and income injection tests, and for unit trust losses, the continuity of ownership and same business tests. Let me bring this to life with a short, hypothetical example. Andrew and Leah are divorced. Both are discretionary beneficiaries of the Wilson Family Trust, and each owns one share in Pasco Proprietary Limited. In March 2024, the trustee made an election specifying Andrew as the test individual. First question, is Leah still in Andrew's family group after the divorce? Yes, and this surprises people. A former spouse isn't part of your family in the ordinary sense, but the law specifically extends the family group to include former spouses. So distributions to Leah remain exempt from the 47% tax. Second question, can Pasco be in Andrew's family group? Only with an interposed entity election. Because Leah owns a share and she isn't in Andrew's family, the company isn't automatically in group, so a separate election is needed to bring it in. Before you elect, weigh 4 real risks. First, irrevocability. The election continues indefinitely and, in practice, cannot be unwound. So decide with the trust's long-term future in mind, not just this year's tax outcome. Second, the 47% exposure. Every distribution outside the family group is taxed at the top rate, so trustees must know precisely who is and isn't within the group before every single distribution. Third, timing. The election must generally be made by the earlier of the trust return's due date or its actual lodgement date. Miss that window and a year's concessions can be lost. And fourth, remember it's not a complete franking fix. An election only bypasses the pattern of distributions test. The holding period rule and the related payment rule still have to be satisfied on their own. This is precisely the kind of decision worth getting right the first time, because you can't take it back. At Quantum House Australia, family trust elections, interposed entity elections, the franking credit rules, and Division 267 trust losses are core areas for us. We assess whether an election genuinely benefits your trust, model the franking and loss outcomes, lodge the election and any interposed entity elections correctly and on time, and then document a distribution framework that keeps you inside the family group. In short, we protect you from the 2 big traps: forfeiting losses by missing the election, and triggering a 47% tax by distributing outside the group. We've served Sydney businesses since 2010 as chartered tax advisors and certified zero advisors on fixed fee packages. So, should your trust make an election? It's worth a conversation before you act. If your trust receives franked dividends but varies its distributions from year to year, if it has prior year losses it can't currently use, if it operates as a discretionary trust that may fail the control or pattern tests, if it distributes to companies or other trusts that might need an interposed entity election, if your family circumstances are changing through divorce, new beneficiaries or succession plans, or simply if you're unsure whether an election has already been made or whether it still suits you. Book a confidential consultation with a senior Quantum House advisor. You'll find us at quantumhouse.com.au or call 1300 809 697. Thanks for watching.